Welcome to Behind the Data. I'm Jeff Krimmel, founder of Krimmel Strategy Group. Each week, I take you behind the energy market analysis I'm publishing online. What surprised me, what I left out, and what I'm still thinking about. Let's get into it. The first post I want to talk about this week is one that I wrote about WTI prices surging past Brent. Since the start of the Iran war at the end of February, we've seen oil prices race ahead, of course, but one of the more interesting bits of that is what WTI, the benchmark U.S. crude, is doing relative to Brent, which is in many senses the benchmark international crude. And I wrote this post because very rarely do you see WTI prices race ahead of Brent, but we're seeing that now. And while I won't go through the mechanics of that, that's all in the post that you can read about on LinkedIn or on the CrimmelSG.com website. I do want to talk a bit about why I wrote about that. There is the element of the novelty that WTI prices rarely race ahead of Brent. But also just because everyone is struggling to figure out exactly what's happening with the war and where things go from here. And commodity markets, specifically oil price markets, are one way that we can get some sense of how a large number of observers, of stakeholders are responding to the ongoing developments that we have in the war. As these market prices swing, we get a sense of how people are responding to new announcements from the U.S. president, new statements from the Iranian regime, new developments reported from the field of combat, new developments that we see from other international stakeholders. And all of this is embedded in the one number that is the oil price. So while all that information collapses down into a single number means we can't always extract an enormous amount of nuance from it, the movement of that number does give us a sense of how the world is trying to process what's happening with the war and what may be happening going forward. It gets very interesting because there's many different reasons that those oil prices can change. So you could have the same players in these oil markets with the same exact views. Say that there's a segment of these oil traders that think this is going to be a very short war and that oil infrastructure is not really threatened, and that as soon as conflict halts, that we will get a quick resumption of normalcy in a lot of these markets. Say that there is another segment of oil price speculators that think that this is going to be a very long, drawn-out operation, and that energy infrastructure, it will definitely be under attack, and that it's going to take a long time for energy systems to normalize after combat operations resolve. Even if those two groups believe exactly those things, and those beliefs don't change over time, as we get new developments in the market, one of those groups may become more confident. One of those groups may become less confident. As a result, the group that becomes more confident wants to deploy more capital into these markets. The group that is less confident ends up deploying less. And as you can imagine, those developments change from day to day. So even if you're not getting people changing their minds, just how people want to wager on what's going to happen to oil prices can move those oil prices around. And of course, we have real supply and demand elements. If there are people that want to buy oil and are afraid that supply will simply not materialize in time, then they're going to bid up prices aggressively in advance. So you have physical market participants here that have a statement in this. You have the speculators themselves that have a statement in this. And then people really are changing their mind, right? There's, as you hear the U.S. president say different things, different points of time, as you hear threats and then pauses between when the threat is made and when whatever action was supposed to happen on the other side, because there may be some new diplomatic development, or it just may be a tool for buying time to try to introduce more leverage and achieve other aims in the conflict. All of this stuff is happening in real time. So people can change their minds based on what they would expect, on how different stakeholders in the conflict are positioning themselves and how they are following through or aren't following through on statements they make, on expectations that other people have for them. It's just a wild time. So when all of that collapses down to oil price and we can watch how those prices move around, that's why I tend to want to write about these oil prices, because they do give us a sense of how well-informed, well-capitalized entities are processing what's happening regarding the war right now. And so while I pay attention to oil prices generally, I'm paying even more attention to them right now, knowing we can infer the broader read on the conflict with what's happening with these oil price moves. The next post that I want to talk about is one that I wrote about whether a closed Strait of Hormuz will encourage U.S. drillers to magnify and accelerate their drilling plans. As we know right now, capital discipline is the name of the game for U.S. oil producers. We've talked about that, frankly, for years at this point, that investors have made it clear that they want to see ongoing, enduring profitability from oil producers. They want these producers to invest as little as possible in terms of CapEx to grow the production base and invest back in the business. Instead, they want these producers to harvest as much cash as they can out of the business and transfer that cash back to shareholders in the form of ordinary dividends, special dividends, share repurchases. All of this exists under the mantra of capital discipline. As an analyst, as a market analyst, it's easy to comment on these realities that exist and have endured, and it's commonly understood this is the reality that exists in the oil field. It doesn't mean we shouldn't talk about it, but there's not a whole lot of dynamism there in the notion of capital discipline. That's been a reality, a prevailing reality for a while now. I wanted to write this post about whether the Strait of Hormuz being closed on an ongoing basis could, in a sense, restart U.S. drilling. I really wanted to write about that because I think it's important that all of us start to think through what would be necessary for U.S. oil and gas producers specifically, but oil producers more broadly, to pivot off of this notion of capital discipline. It's easy to think capital discipline is what the market wants today. It's what it's wanted for the past 2 or 3 years, so that's what the market will want in perpetuity. And yet, for anyone that's followed oil and gas markets, we know these markets change. The investor preferences change. Management teams, their actions change as a result of what investors want. The markets change. The valuations change. Just all of it is there's a lot of turbulence there. And so there's no reason to believe that capital discipline is going to be the reality in perpetuity for oil producers. So if we don't believe, maybe some do, right? And it's I suppose understandable because capital discipline has been around for a while now, but seeing all the turbulences exist historically in these markets, it is worth asking, what would be necessary for producers to pivot off of capital discipline? And if the Strait of Hormuz remains closed, this is one mechanism that I could see encouraging U.S. producers to drill more. And I think what would happen is there'd be such restricted flow of oil, gas, LNG, finished petroleum products coming out of the Persian Gulf that U.S. producers would need, they would recognize there is a call on U.S. crude. There's a call on secure crude supplies. And I could imagine the messaging being built around some combination of U.S. oil producers are going to be good global citizens. There are people in Asia Pacific, there are people in Africa, there are people in Europe that need this energy, that cannot get this energy because of the closure of the Strait of Hormuz, and U.S. producers are in position to respond and offer the world this energy that is so profoundly needed at this point of time. There's also a patriotic element to this messaging that the U.S., particularly in the parlance of the Trump administration, this notion of energy dominance, that the U.S. needs to be the supplier of, the premier supplier of global energy. And so U.S. producers are going to meet this patriotic obligation of demonstrating the extent to which the U.S. can dominate the global energy discussion and produce this extra energy and make it available both to Americans and to the rest of the world. And so I think that kind of messaging is what would allow oil production executive teams to start to introduce some space between them, their posture, and this notion of capital discipline. When we get to those stories, if we do get to those stories about being a global citizen or performing their patriotic duty, these executive teams would also try to thread this needle and make it clear to executives that we are not throwing away profitability. We are not throwing away the great care and discretion with which we're architecting our capital programs. But the world needs this extra energy. The price signal is there for us to produce more, to capture more on the back end. With these added profit dollars, not only can we bare minimum sustain our dividend and share repurchase programs, we can probably add to those and at the same time invest back in growing our production base. There needs to be a belief and a conviction and a data-supported argument that this closure of the Strait of Hormuz will remain. That there's an element of that will endure, whether there's a tolling arrangement there, whether there's whether Iran's making it clear that going forward they now view themselves as being the gatekeeper of that passageway. There needs to be something that gives investors, the broader market, a sense that this call on U.S. crude is enduring. And so this is just one tangible, immediate mechanism where we could see U.S. drillers restart and add to their capital programs. And, who knows what the chances are that ultimately happens. But I do think this is something I think a lot about, which is these realities that exist in the market that are taken to be truth and that are largely unquestioned. These are things that we don't have to spend every day questioning conventional wisdom, right? There's some efficiency in running with the common understanding of how these markets work and what the prevailing reality is. At the same time, for something as important as the notion of capital discipline, it is worth it for all of us to ask, what would it take for us to see some daylight between the executive teams at oil producers and this broader notion of capital discipline that we've become so familiar with over time? This Strait of Hormuz element is one of those mechanisms. So something I wanted to dive into because of the way that I try to challenge myself to think through how these oil markets may evolve going forward. The next piece that I want to talk about is one that I wrote about the first bit of cargoes here that will be loaded at Golden Pass LNG and how that will help offset some of Qatar Energy's production that went offline in the Gulf as a result of the war with Iran. This one, I wanted to write about this because I have been bullish about the U.S. Gulf Coast for a long time, several years at this point. And when there are news items like this, I tend to explore them, unpack them, explain them a bit because I want to keep giving more data points around why the market is finding more and more opportunity to deploy capital along the U.S. Gulf Coast. And we're hearing more commentary about natural gas in general. The phrase that you hear from the Baker Hughes executive team is that natural gas is a destination fuel, right? It's not a transition fuel, it's a destination fuel. And as the market wraps its mind and arms around this idea that natural gas may indeed be a destination fuel, it may be what many countries around the world end up embracing aggressively and for long periods of time, then the idea that LNG, where capital is flowing within LNG, becomes even more important to unpack and to disentangle from current events and to think through what is the long-term trajectory here. So I wrote this piece because, as we just talked about in the previous piece, the Strait of Hormuz is a very risky channel to build energy infrastructure behind. And an entity like Qatar Energy has an enormous amount of capital they can build all over the place. They're a partner here in the Golden Pass LNG facility on the U.S. Gulf Coast. And so one thing we're learning from the Iran war is that I think there's going to be more hesitation to build up energy infrastructure that lives behind the Strait of Hormuz. And so if you want to build it beyond the Strait of Hormuz, where do you go? In many ways, it's becoming clear, and it has been clear, but it's just being emphasized that the U.S. is a great place to build out this capacity. And there were some rumblings, right, of whether the LNG capacity that's being built along the U.S. Gulf Coast today, all this expanded capacity, is too much. And yet, now that we have the Iran war, we're seeing that with energy infrastructure being more vulnerable than a lot of folks would have imagined in advance, the U.S. Gulf Coast is just increasingly attractive. So I wrote about this piece because it's of interest in the moment. There's an enormous amount of capital implicated in what's happening here. And it points to a truth that that is likely to become even more important as a result of what's happening in the Iran war. Right? There's a fair bit of what's happening in the Iran war that is going to be transient. It'll be resolved whenever the conflict does get resolved. There will be some recovery, whether it's fast or slow, we'll see. But there are some elements of the broader energy apparatus that will fundamentally and enduringly change as a result of what's happening with the Iran war. And it is quite possible that the nature of LNG, where the export facilities are being built out, how much capital flows, when that capital flows, that a lot of those variables are profoundly changed as a result of what's happening right now in the war. So it's an area I pay a lot of attention to. That's why I wanted to make sure that I got that piece together this week. The last bit that I wanted to talk about here was the Oil and Gas Market Mastery program. That's the program I built, a 12-week program where we had 20 oil and gas professionals come through it in the founding cohort. That cohort has finished. We finished the 12 weeks just this past week. And while I've celebrated that, and it's been an exciting thing to do, exciting thing to work on, a great way to collaborate with some really impressive people in the industry, it has caused me to think a lot. I was thinking as I was putting the program together, as we ran through the program, and now that I'm reflecting on the founding cohort around my why. Why did I build that program? And one of the things that has hit me over time is, as we all know, right, the industry is consolidating. We see headcount going down in a lot of places, and yet energy flows are going up. We're producing more oil and gas. We're even in the U.S., the refinery throughput is more or less flat. We're expanding capacity in some cases, and so the energy industry on the whole is asking fewer people to do more work, and that's partly a result of there's such incentive to harvest every efficiency imaginable in the energy domain, specifically in oil and gas and the broader hydrocarbon space. That's what investors demand, and so that's part of the reason that there's a big push around digital broadly, AI specifically. And so you want to harvest as many of those efficiencies as you can. Again, to speak back to capital discipline, that you want to grab as much of that cash, transfer it to shareholders in the form of dividends and share repurchases. And so labor is an incredibly important cost bucket for almost any energy company. So there's a big push to consolidate. It's why we've seen headcounts continue to drop across the industry. So again, we're asking more out of fewer people. And what that means is we need this existing generation of energy leaders and our future generations of energy leaders to be at least as well equipped and very likely better equipped than any generation of energy leader that has come before. And with these efficiencies, not only is headcount going down while energy supplies are flat to up in almost all domains, but learning and development budgets in a lot of places are getting cut, right? There's less investment in professional development than we've seen historically. As these companies consolidate, we get more and more people concentrated in these fewer places, and as those programs aren't made available, they don't scale out to the same number of people, and then we have all these smaller to mid-sized entities that it's a lot harder to stand up formalized learning and development operations internally at these smaller shops. And it just became increasingly clear to me that this is one way that I can contribute, is by packaging a lot of the tools that I have built to learn, to study oil and gas markets, energy markets more broadly, to build these defensible outlooks about where these markets are going to go so we can help make better decisions, to communicate those outlooks to senior leadership, to clients, to boards, to any senior stakeholder that's heavily involved in how capital flows through these energy sectors. If I could package those tools and help offer that to the industry as a whole, that would be an important way for me to contribute, where I feel like I'm making an important difference and I'm making a contribution that is more valuable today than it would have been in the past because of how much more we're asking of today's leaders and of those future leaders. So it's been something I've just reflected on a lot here this week in particular, as we've wrapped up the founding cohort of Oil and Gas Market Mastery, that I found the 12-week program to be even more fulfilling and engaging than I had anticipated. A lot of that has to do with the 20 people that went through the program. They're just phenomenal people, very capable, deep expertise in their various domains, deep curiosity around how these markets function and what is the best way to understand that and to package that and then communicate that. And I've just reflected, why am I feeling so much more impact coming out of those 12 weeks even than I had anticipated? And like I said, the people matter a lot, and I think it's this notion of that this industry needs this offering right now, and it's an exciting position to be in, to put that together, engage with folks that are doing incredibly important work all across this sector, and get plugged in that way. So it's something I'm very grateful for and very excited about. The next cohort launches on Thursday, April 23rd. If that's something you're interested in learning more about, you can send me a note on LinkedIn, or you can visit the page I built at kremlsg.com/OGMM for Oil and Gas Market Mastery. As always, thanks so much for listening to the episode, and we will talk again next time.